evening. You're watching Stock Watch with me, Zinati Goma, and joining me to unpack your stock-related questions tonight are Jean Pierre Verster from Protea Capital Management and Rowan Williams from Nitrogen Fund Managers. Be sure to send those questions via SMS to 41392. Email at stockwatch@bdtv.co.za or tweet us at BusinessDayTV using the hashtag StockWatch. Thank you so much for your time, Rowan. And of course, let's get the ball rolling. I will actually start off with a question from a viewer because markets are waiting for the Fed minutes. And of course, markets have now started pricing in rate cuts at this point as they see a lot of the central banks keeping rates on hold for the rest of the year. And actually starting off with the Fed. The viewer says, I think the Fed is done with interest rate hikes as inflation might have peaked. To me, I don't have that much faith in the Fed. They kept saying inflation was transitory and delayed hiking rates. I think it's 50-50 that they will be too slow to drop interest rates. Does your panel agree or not? So, Rowan, starting with you, is the Fed done with interest rate hikes? And do you think that they might be too slow to drop interest rates?
Yeah, I might sound like Jerome Powell, but I say, well, it's all data dependent. Yeah, it does seem like they are done with, I think, hiking. We have seen the sort of near-term data being more positive in terms of a pause and at least maybe the end of hikes, because we have seen a pause already. So inflation is coming under control. We're seeing some of the job figures also moderate quite significantly, because we had a period where there was strong hiking, but jobs remain strong, but they seem to be slowing down. And I think that's what the market was also waiting for. Jobless claims also on the rise. So those generally point to a cooling economy. And I think the market feels that the Fed has done enough to tame inflation. So I think it would be a surprise at this point if they did hike again. And what we are starting to see, as you pointed out, that we're now starting to price in rate cuts. Again, that will be very dependent on the trajectory of inflation from here. Inflation expectations have proved a little bit sticky. And I think the Fed wants to see those come down before it's going to cut. So in terms of erring on the side of caution, I think it may do that. They've got themselves into a situation where they were able to create a significant buffer of much higher rates. We've had a period of roughly 20 years of very low rates. So I don't think they want to give it up that easily. It is handy if there were another crisis that they could cut. So they do want some buffer. So I think they will be cautious as long as the US economy is strong. They are not going to cut too quickly. So price stability is one of their key mandates, and they're going to stick to that.
Yeah. And I mean, just the concerns of a policy mistake have been rife since the beginning. I mean, even the Fed, I guess, didn't want to make a policy mistake by calling inflation sticky too early. And also, even with the rate hiking cycle, there have been concerns that, what if they they keep on hiking rates and they make a policy mistake? JP, do you think that they could be considering the hawkish tone that they keep coming with, do you think that they could be a policy mistake of dropping rates too late?
Sure. Yes. But I would also add to say that the reason for the question by the viewer is effectively to make a decision on equities based on what the Fed will do.
Yeah.
I'll just say, if you go back a year, and you made your equity investment decisions based on what the Fed might do and what people were expecting, we would have gotten it very wrong, because interest rates, the expectations for interest rates have risen very sharply from a year ago. Yeah. And the interest rates themselves, the Fed fund rate has risen very sharply from a year ago. No one thought a year ago we would be where we are today.
Yeah.
But notwithstanding that, the equity markets have not fallen in a heap. The equity markets actually have had a very good 12 months. So be careful if you are investing in equities to necessarily think that only central bank decisions drive the equity market. It is more complicated than that. It has to do with earnings expectations. It has to do with expectations of earnings expectations.
Yeah.
And your long-term interest rates as an indication of the cost of money, your discount rate, your opportunity cost, is just one element of that. So don't be too fixated on that, because what we have seen again the past year is that no one really knows. No one can really accurately forecast what economies will do. And then central bankers base their hiking or cutting decisions based on the expectation of what economies would do. So that's why the central bankers were surprised a year ago, and they thought, oh goodness, they're behind the curve, and they needed to raise interest rate very sharply, and they were criticized for being too slow. And as you now say, Zanati, they might again be too slow, or they might be too fast in cutting.
Yeah.
We don't know. But the good news is, if you stick to high quality companies and you don't overpay, it doesn't actually matter what the central banks do.
I hear you, JP. I hear you. All right, so let's move on to more questions. This one is on gold. Panel's view on holding gold. And if you are going to hold gold, do you go for gold miners or gold ETFs like GLD? And if you're holding both, what percentage? Or actually, if you're holding gold, what percentage of your portfolio? So, Rowan, what's your view on holding gold, and would you be going, if you are going into gold, going for the miners or ETFs, and what percentage of your portfolio would it be?
Yeah, so I guess the simple answer is 0%. Well, that's what I'm holding. And I mean, gold's an interesting asset class. It typically is a hedge against inflation, and it has actually done quite well. It recently just passed again through the $2,000 mark per ounce. So that's quite positive, obviously, for gold mines. But it can cut both ways. Gold mines are really price takers. They have very little control over the gold price. They don't really control the supply directly. So it could go down. And as we've seen with the platinum miners, just as an example, how deeply it cuts when the price of the commodity that you sell goes down. So what I would say is, if you were to hold gold, especially if you look at the gold shares, some of them have done particularly well. Harmony stands out. They seem to be trading at a slight premium to the basket of, well, gold really in rands. And so at this point in the cycle, I'd probably hold the ETF if I were to be holding gold. But I think, as JP said, there's better assets out there. There's businesses that produce something that's useful for consumers or the economy, and is a better inflation hedge overall. So, but gold as an asset refuses to die. So there will always be people, I think, that are interested in it.
JP, would you be interested in it or not?
Well, gold refuses to die, but it also refuses to multiply.
Oh, yeah.
If you put two gold bars together, they don't make babies. They don't make dividends. So unfortunately, if you have an ounce of gold, you'll always just have an ounce of gold. And your ounce of gold will not pay dividends.
Yeah.
It will not generate the return. The only way you can generate the return on your ounce of gold is to sell your ounce of gold to someone who will hopefully pay you more fiat currency, more rands or dollars, than what you bought your ounce of gold for. So in my mind, that is not the definition of an investment. For me, something in which you can only get return once you sell the asset is a trade. It's not an investment, because you need to trade out of it to make your money. I like companies where I buy a little piece of the company, a share.
Yeah.
And there are people who go to work early in the morning, and they work hard, and they generate profits. And then once or twice a year, they pay out a small portion of their profits, sometimes a large portion, to their shareholders. So I can sleep well, and my shares effectively multiply. They pay dividends. They become worth more, and they throw off cash. So I agree with Rowan. I would not hold the gold shares in terms of the miners. I'm actually short gold miners at the moment.
Yeah.
And if I was forced to, I would hold the gold ETF, but I would prefer to hold productive assets like shares in a company, because I think that's a better long-term investment than not just a trade.
Well, since we're on the topic of miners, there is a question on Thungela and Exxaro. I have an existing exposure to both Thungela and Exxaro in my portfolio. The performance of both has been relatively flat. I'm considering consolidating this exposure. What are the panel's thoughts? Rowan?
Yeah, so that's quite interesting. With the Thungela, you're getting just the coal exposure. Exxaro, you're getting coal and iron ore exposure. So, and I think people forget Exxaro has quite significant iron ore exposure through that Sishen Iron Ore Company in joint venture with Kumba. So, and if you look at the point in the cycle, mean, we have seen oil come off quite significantly, notwithstanding, I guess, some of the conflict in the Middle East, and so has been disappointing to some extent. Coal prices off that energy complex, so it's also been a little bit softer. And actually, Exxaro is screening cheap at the moment. It is somewhat of a holding company, so you look at it on a sum of the parts, and versus at least the value of the underlyings, it does look quite cheap. So an opportune question, we would consolidate Salva Tungela and go put it all into Exxaro. It also pays good dividends, and you've got, I guess, some diversification. It's not only one commodity that you have exposure to, and yeah, dividends look good. I think prospects for iron ore look reasonable with sort of the Chinese trying to do a lot for their economy. Actually, iron ore is quite strong at the moment, so it is a reasonable level to consolidate and swap into Exxaro.
Yeah, so Rowan, speaking about going for Exxaro for the diversification, JP, on your side, is it looking like, how would you play it? And is it looking like the party for Tungela is very slow to come back?
It was a huge party, so that means there's a huge hangover now after the very high coal prices just after the Russian invasion of Ukraine. So it does mean that Exxaro is in a better position probably. And as Rowan has said, the iron ore price specifically has recovered quite nicely year to date. And very recently, because of certain news coming out of China, that the government wants to support the property industry. And that supports iron ore because it's a key input into steel, which is a key material into home building. So the direction of movement for Exxaro is better than for Tungela. The other part of the equation is, though, that Tungela is cheaper on a, call it, spot basis, a PE basis. So do you go for the one that's cheaper, or do you go for the one that isn't as cheap, but it is moving in the right direction? Its fundamentals are improving at a better rate. And between the two options, I would probably go with the same option as Rowan and say I would rather have exposure to iron ore as well, not just for the diversification benefit, but also because iron ore's price is rising, while the coal price seems to be flat after the big bubble we had. And that means even though Tungela is cheaper, I would prefer to be buying the share that's got the better fundamentals that are improving as we go forward.
All right. Well, actually, JP, let me come to you first because there is a question for you specifically about Match Group. Should I still hold Match? I bought the share on his recommendation and it's 40% down. Does he think it will recover, or should I cut my losses now?
Yeah, there's no love lost for Match Group, the holding company of Tinder. But things are quite bad in the whole industry. That, like the CEO of Bumble, which is a competitor, actually stepped down less than a month ago. So there's a lot of issues at the moment in that industry. It seems like post-COVID, people aren't too fond of meeting up and connecting via apps. And the apps have maybe gone too far in terms of monetizing the platform. So if you really want to meet people and want to swipe and want to connect, these days it sounds like you need to pay a lot to do that. The free option doesn't work that well anymore. I still believe if you look at the strength of the platform and the innate human nature to want to look for connection, including physical connection, it does mean that I think the dominant platforms will do well, and Tinder is still the dominant platform, even though there are a few competitors now. So while they do have short-term challenges, leadership challenges, and like I said, the whole industry being under pressure, we still hold in the Protea funds, and it is disappointing how it's done the last 6 months, but we are holding and waiting for better days.
All right. Well, some people that were really hot on something, on NVIDIA yesterday, it did trade at almost an all-time highest, and of course we will be getting the results out tonight. So what do you think the NVIDIA results will be tonight? Well, it seems that investors are expecting a lot, Rowan.
Yeah, so it certainly has been a really hot story, hot stock. I mean, it has driven to some extent the entire market's returns this year. So the whole AI space and obviously chip demand has been huge. So people will follow it very closely. A huge amount of expectations are in the price. So, yeah, I guess it's relatively easy for them to disappoint. Does look like demand remains very strong. They're doing a lot of innovation. A new chip that'll be twice as fast, going to be launched in the first quarter of next year. That got the market excited as well. So I think obviously the results and what the sort of demand expectations look like in the near term will really determine the share price reaction on the day. It could move quite a lot. I think, as I said, I think a lot of expectations. So there's a potential for a disappointment. Even a 5% pullback would not be sort of significant relative to the run-up, and I think a lot of people would see that as an opportunity to buy. So it's probably going to stay quite firm, but it's going to be watched very closely. I think this is a key part of the market. Even the whole sort of conflict at OpenAI just shows you sort of how much focus there is on the space right now. So it's going to be very interesting.
Yeah, there's a lot that investors are hanging their hat on here. JP, what would you make of it if it does disappoint on something, even slightly?
Yes, well, because of the very high expectations in the share price, if they do disappoint even slightly, it could be a material downward move in the share price. That's why they really need to come with a positive surprise, because you can see from the share price movement recently that people are expecting a lot and a lot of optimism. Now, Rowan did mention the issues at OpenAI with Sam Altman being pushed out over the weekend, and then yesterday Microsoft saying you can come work there. But it shows that large part of that reason is there's a feeling that maybe things should go slower. And if the whole idea of artificial intelligence is that we should go slower, that's not good for demand for the chips that drive AI, that NVIDIA is the leader for. So we had a very interesting time, and that's why there's so much focus on the NVIDIA results tonight, not just for what happened in the past 3 months for the quarterly result, but also the prospect statement to hear what they think going forward and the type of orders they have to see if this frenzy is continuing. Generally, I don't like frenzies. Frenzies are normally equal to bubbles, and when you're in the middle of a bubble, you don't realize you're in a bubble. It's only with the benefit of hindsight that you see you were in a bubble. So I think a year or two from now is going to be interesting when we talk about AI and NVIDIA, whether we have the benefit of hindsight and look at it slightly differently to what we are looking at it today.
All right. Well, let's get to Sibanye. I see Sibanye is down a lot today. I've been interested in buying mineral companies for some time now. I bought a couple of shares at 23 Rand. Could this be a good time to add more Sibanye shares to my portfolio? Rowan?
Well, yeah, certainly better than yesterday. So the share down, over 20% on the day, off the announcement of the $500 million convertible bond offering that they basically concluded today. So that results in effectively a massive share issuance. If those bonds do convert, it would be about 14% dilutive to existing shareholders. So the bonds actually look like a reasonable prospect, because you're getting sort of a base US dollar return of around 4.25% with potential equity upside. And I guess from this level, the strike at 30% or so above today's reference price looks like it could come into range easily over the next 5 years. So there has been a lot of hedging that I think went through the market. The volumes were huge in Sibanye today, so that put also a lot of pressure on the share price. So it is a pretty good entry point. They will have significant capital, I guess, to take advantage of deals in the cycle. They already announced one last week. So you do have to believe to some extent in the whole platinum story. I guess if you're already a shareholder and you do, then it certainly makes sense to add lower down, and this would be a reasonable entry point.
All right. Another question on Sibanye-Stillwater. What's the forecast for it in the short term? And a cheeky one here. Why doesn't Anglo buy them and boot Froneman out? I think he is getting too big for his boots. JP.
Well, yeah, if you say Anglo, it won't be Anglo-American, and Anglo Gold Ashanti has also moved outside of South Africa, not having any material exposure in South Africa. So it wouldn't make sense to buy a company with still significant gold exposure in South Africa. That'd be against the strategy. So that's to answer that one.
Yeah.
Look, I agree with Rowan. I think in the short term, like tomorrow, there could be a bounce, because a lot of the pressure today was because of this hedging. If you are a hedge fund or a fixed income investor and you bought these bonds, you effectively get a share option as part of the bond, connected to the bond, implicit with the bond. And for you to hedge that equity portion, you would short some shares. So because the bonds were issued today, there was a frenzy to hedge that long equity exposure by shorting Sibanye shares. But now the bonds have been issued. So maybe some people might do a little bit of hedging tomorrow, but as soon as the hedging is done, and I think that's very soon, you should see a small bounce. But longer term, I think if you look at the PGM basket, it's a tough space for all PGM players, including Sibanye. So in the short term, maybe a bounce, but longer term, I'm not positive about the company.
All right. Rowan, here's a question on Naspers and Prosus. There were late trading statements by Naspers and Prosus last night, which looked decent. Did the panel have a chance to analyze? To be quite honest with you, I just saw a headline that they do expect the interim profit to jump. Rowan, did you have a chance to comb through those numbers?
Yeah, so the sort of trading statements are sort of a little bit of a guessing game because quite a few moving parts. They take Tencent's numbers a quarter back and put them in their numbers in terms of the earnings. So I think what we tend to focus on is the sum of the parts, the discount to NAV, the performance in the underlying e-commerce, I guess the rest of the portfolio, what some people call the rump, the non-Tencent assets. And I guess the commentary that we saw, it did look positive, that they have moved some companies, loss-making businesses, into discontinued operations, and they did see traction in the balance of the e-commerce portfolio. So we've also got a new CEO that's going to be presenting the results. So I think results are quite well anticipated again, and the tone that they set. I think what was interesting this evening, they came out with an update on their share buybacks, and they actually have accelerated those in the last week. So, and they did point out in the trading statement that they committed to those. So that's a key part of the investment case going forward. And so that does look quite positive. So we remain quite constructive because we think from here, things are going to be moving in the right direction towards narrowing that discount as best they can. And that's certainly positive for the share price.
Last question before we get to your stock picks. A question on Naspers and Prosus as well. Which one do you prefer, JP?
I prefer Naspers because you have a double discount. You have the discount between Naspers and its holding in Prosus, and then the discount between Prosus and its holdings of majority of the value being Tencent, but also all the other bits, as Rowan calls it, the rump. And I do think that the share price maybe did not perform very well today after that trading statement because there was a slight disappointment that there wasn't another big bang, another big announcement of some corporate action that they could do. But I think it's generally positive that they reinforce that they will continue with the share buyback. They're going to continue with what they're doing right now. And if you're patient, I think that will unlock value at the Prosus and particularly at the Naspers level.
All right. Well, gents, let's get to your stock picks for today. Rowan, what will it be?
Yeah, something with the Black Friday theme. We're choosing Foschini Group. They have reported, even though their earnings were somewhat disappointing, I think the prospects are looking quite good. They've held a series of investor engagements. We're seeing a lot of investor interest. They're very much a forward-thinking retailer, omni-channel, and have a very big exposure in the South African market, but also in the UK and Australia, and at a reasonable price here. And I think prospects look good. So, yeah, we like it for the medium term.
All right. On your side, JP, what will it be?
So I mentioned a double discount when it comes to Naspers. Here's another company with a double discount. It's Ethos Capital Partners. It's an investment holding company. They announced roughly 2 weeks ago they probably won't look to make new investments. They look to realize their current investments. It is trading at a significant discount to its own intrinsic value. And this management team will not dilute shareholders by doing a rights issue at these low prices as some other investment holding companies have done. They will look to realize the value, so that unlocks the first discount. But they also have a significant stake in Brait, another investment holding company that's also trading at a significant discount and is also looking to unlock the discount. through distributing their Premier Food shares, which is a Premier Group, which is listed on the JSE. And then they have Virgin Active as well as a significant investment. So between the discount being unlocked at Bright and the discount being unlocked at Ethos, I see significant upside and a management team that's going to actively look to unlock this discount, double discount, in the short term.
All right. Well, thank you so much for your time and those very interesting stock picks. Gents, really appreciate it. That's all for Stock Watch this evening. Thanks to our guests, Jean Pierre Verster from Protea Capital Management and Rowan Williams from Nitrogen Fund Managers. Up next, The Close. Stay with us.